Hey there, and welcome to Real Investment News. I'm Mike O'Neill. We are closely watching the markets this morning. All three bounced higher after the opening bell. The Dow at one point was up more than 500 points. That's actually up more than 2%. Things are cooling off a bit, but they are still up. It is obviously way too soon to know if we're going to continue our bullish climb or if more corrections are coming. But in his latest article, Lance Roberts offers his thoughts right off the get-go. The cycle will end, the simple math of forward returns. Now, in it, he notes that no matter how long the expansion, there is always a decline. Now, this chart goes back to 1871, and you can see for every expansion, these blue columns, there is a market decline, the columns in red. The length of the expansion and the decline are not always equal. One is often longer than the other, but it does happen. But right now, we are in 105 months worth of expansion. We're just waiting for the decline. And when it does happen, it can take a long time to recover. Now, we showed you this chart a couple months ago. It shows how the S&P, when it dropped in 2000 after the dot-com crash, it took 16 years to recover to get back to the levels it was at. And that was actually pretty quick. When you take a look back at past dips that have lasted, say, 23 years, even 29 years, that's why you can't just set it and forget it. These drops hurt, and heaven forbid that you try to retire at these times. So here's the simple math part. If you have a financial advisor telling you to invest in a fund and then come back 30 years later because the market has a 10% return over the long term, you have to watch out. Because yeah, you get 3 years of 10% returns, that's great, that's your average return. But if you have a bad year and say lose 10%, well then your average return drops to 5%. And it would require an unprecedented 30% jump in 1 year, just in year 4 here, to get back to your average return. Now, do you remember this chart? It's based on a guy named Bob who invested $100,000 back in 1988. It's hypothetical. In addition to his initial deposit, he's also going to be putting in about $625 into the account every month because his goal is to retire in 30 years with a $75,000 income. Now, this purple line actually shows you how much he will need in the bank to take out $75,000 a year throughout his retirement. It's $5.3 million. Now, if Bob just puts the money in an index fund and walks away, in 30 years, he's only going to have $1.7 million because these drops keep pulling it down. But if he actively manages the account by, say, going to cash every time the index falls below that 12-month moving average, take a look at this blue line. Not only can he actually meet his goal, he can go beyond it. After 30 years, $5.7 million. Now, as you have heard, everything that goes up must come down. Trees don't grow into the sky forever. These bull markets are going to decline. We just don't know when, obviously. So you can't just sit back and hope that everything works out. Keep your eye on the markets. Have a strategy to move the money when needed. Your future self is going to thank you. And as always, you can take a closer look at all these charts. Read more of Lance's analysis at realinvestmentadvice.com. In the meantime, I'm Mike O'Neill. Thank you very much for watching. Be sure to follow us on Facebook, Twitter, subscribe to our YouTube page. We will see you again in a couple of hours.